Hi there, John Hardy here with the Saxo Bank FX update on this February 7th, a Monday, and we're getting off to an incredible start in risk appetite. Let's look at the news flow overnight out of Asia. First, we had in Australia, we had a very weak Australian construction survey, the weakest in a long time. I believe it was July '09 or something like that, the last time we saw such a weak data point. Strongly contractionary or recessionary number in the construction industry, but as we'll show you a bit later, it doesn't matter if the entire Australian economy outside of mining is looking weak and possibly slightly recessionary. It's all about the commodities boom and asset markets. Also out of Australia, we had a weak December retail sales number, particularly weak, I would say, in light of some headline increases in basic input costs and necessities like food and energy. But not much market reaction, with risk appetite doing fairly well, with China offline still today and tomorrow as well, I believe. Not much reaction to this, and again, Australian dollar not affected much at all, and we're seeing it actually towards the highest level it's seen since it peaked out late last week. We'll get to those charts in a second. Just this being Monday, and often Mondays are a bit slow, we'll have a look at some of the key highlights this week. The most interesting thing, I think, in light of the big break higher in interest rates or yields in the U.S., especially the 10-year, which we'll also look at in a moment, is the fact that we have a trio of U.S. Treasury auctions this week: the 3-year tomorrow, the 10-year on Wednesday, and the 30-year on Thursday. As well, we have, to round out the picture of the Australian economy, the January employment report is out Thursday, and Bank of England also out on Thursday, though of course they don't release a statement usually, so we don't get much out of that, especially as we're not expecting any rate move just yet. Also on Thursday we have U.S. jobless claims, looking for the trends to go the one way or the other. We do need a sub 400K level of consistency before we can really talk about stronger signs of an improving U.S. job market. And the trade balance on Friday, and the last couple numbers there have been pretty decent. So going back on that Australian note, let's have a look at a couple of charts here. This is a chart, thanks to Bloomberg for this chart, which you're able to stack a few different indicators and markets against each other in a single chart. And here we have in green the copper price, in red the differential between Australian 2-year and US 2-year rates, and in white we have the Aussie dollar rate. And we see how this is very much part of the ups and downs in the copper market, which is also a proxy, you could say, for risk appetite. And especially lately with the financialization of the copper market, everybody's warehousing it and hoarding it and stocking it, and it's hard to tell what's driving copper in terms of actual consumption and what's driving it in terms of the financialization of it. Regardless, that's a key driver for Aussie. It is kind of interesting to note, however, that we're seeing the interest rate spreads not really going to the upside and following the general development in the copper market and the swings in risk appetite. So that's a key thing to look for, the tension between those two indicators beginning to diverge somewhat. So keep that one in mind going forward. As well, just to remind where we are in interest rates this week, with the key bond auctions coming up, Treasury auctions coming up in the U.S. We have this very long-term range here all the way back to mid-December, where there's a lot of uncertainty trading in the range in U.S. 10-year note. We finally broke higher last week with this big bar and tried this 200-week moving average. Technical level there appears to be a break. If we zoom out to the bigger picture here, we can see that this 200-week moving average was kind of interesting before. Even more important, though, than the moving average is the 4% level. We're getting pretty close. We're only about 33, 34 basis points away. But you can see how the 4% level in yields on the U.S. 10-year is quite an area of resistance and will be key to testing going forward. This level is not really held since the global financial crisis broke. And you have to wonder, again, with risk appetite booming, and one of the reasons for the booming risk appetite being easy liquidity, whether the market starts to view this with concern that rates are headed so high. Going to the charts in FX, let's have a look at Eurodollar to start. We've seen some new lows today, a bit back and forth after we've reached those new lows. There's not a whole lot of impetus to push the dollar stronger, considering where we are blasting higher on risk appetite today, but still consolidating. We've got a little ways to this final key line here at around 134.30-50 area, which I think is important to see if it holds. Dollar Swiss, we have this descending trend line just tested today. We also have the 55-day moving average. Those are the key levels going forward. We talked about this last week. And the yen crosses. The yen cross is very important this week with all of the implications for interest rates from these U.S. Treasury auctions. We saw quite an interesting bar daily candlestick on Friday. The follow-through today, not very impressive so far. Next key area is the Ichimoku cloud, a bit higher. I think it's 82.56, and then this 55-day moving average, which has been quite interesting on a number of occasions, and that's closer to 83, just below 83. Elsewhere, with bunds coming off their lows established earlier today, we're seeing a bit of resistance on the Euro-yen chart. And sterling yen, I think, also a very interesting chart to look at the moment. We had a very bearish sort of test higher at the 200-day moving average that failed, created a pattern. Then we saw an engulfing bullish pattern that sort of seemed to reject that, and now we're seeing doubts once again whether this new attempt at highs is going to hold. So I think a lot of tension here and these yen crosses, and I think that's just an echoing the tension in the direction in interest rates. As far as the overall dollar view, of course, just an incredible run in equities we've had here since the late August lows. Guess who came out saying QE2 was on the way around August 27th? And of course, we have to wonder if this just simply runs until we get closer to the end of QE2 before we see an end, or if the market starts to anticipate it before then. Anyway, on a technical note, kind of interesting to see that we're at this top of this sort of rising channel, and price is actually peaking above there that's been established, and sort of the nosebleed levels on risk, if you will. On Aussie dollar, we still have the high in place. Had a little bit of a reversal pattern on Friday, trying to see it test higher. And if we look at a local area, an hourly chart here, we can see the Fibonacci of 101.63 or so still in place. You could argue 101.80 might be the final resistance area there. But we need to see it diving back below parity before we can get a better indication that some kind of high is in here for risk appetite and for the pro-risk currencies like the Australian dollar. So as we head into this week, look out for those bond auctions and the key levels in the various charts, as it looks like dollar's in kind of a technical limbo here, and we need to break one way or the other in the coming several days to get a better directional indicator going forward. That's it for today. Have a great day, and we'll check back with you tomorrow.